Hi, I'm Mark and you're watching Mark Talks ETF. In this show, I regularly share my exchange traded fund or ETF research and the techniques I use to grow my portfolio. Now, if you're already a subscriber to the channel, get 1 minute of your life back and fast forward to the next chapter. If you're new to the channel, give me 1 minute to provide some additional context as to how this show can help you. Firstly, this channel is aimed at UK and European ETF investors. US investors, it's probably not relevant to you. Now, like many investors, I prefer to invest in ETFs as opposed to direct equities or shares. ETFs are a low-cost way of diversifying portfolio risk, and they enable investors to get exposure to a theme or country or an asset class. Information on ETFs is easy to obtain, but comparing the performance of ETFs is difficult and it's frustrated me. So I built a database which permits easy comparison of ETFs across providers, asset classes and countries. And I created this channel to share the analysis of past performance of ETFs with my subscribers. My aim is to validate your existing investment strategy, provide a counter argument to your current strategy, or simply bring to your attention ETFs that you were unaware of. Now, Warren Buffett famously said the only piece of financial advice he would give is to invest in the S&P 500 index. So throughout the show, we continuously compare to the S&P 500 index as a benchmark. I split the show into 5 sections. Firstly, commodity ETFs. Then we look at option ETFs, then bond ETFs, and then finally, equity ETFs, and anything else that I think you might be interested in. Now, the show is journalism, and it doesn't represent financial advice. You should always undertake your own investment research. And remember, prices of ETFs can rise as well as fall. If the analysis sounds useful to you, hit like and subscribe, and there's no need to watch this section ever again. So first up, let's look at the commodity section. Now, I typically hold 10 to 15% of my portfolio in commodity funds. Commodities provide a good way to diversify away from equity-related risk. As an example, a significant fall in the Nasdaq or the US tech stocks is unlikely to be directly linked to the price of precious metals or agricultural commodities. So, turning to the top of the commodities table, we have palladium taking the top spot, with a gain at the end of January of 13%. The other precious metals, silver, platinum and gold, are right behind with gains of 8 to 9% for January. At the bottom of the table, we have the industrial metals and natural gas. Now, while we're on the subject of commodities, another way to get exposure is via mining ETFs, i.e., buy the ETFs holding the shares of the companies which mine the commodities. We can see that gold miners have gained 17% in January, with top spot going to a Van Eck fund, with an iShare fund taking second place. This is double the return from holding the gold commodity ETF, which we saw a moment ago had a gain of 8% year to date. Now, Global X Silver Miners takes the 4th spot. In the centre of the table, we have the oil companies, ticker ESIE and iShare Europe Centric Fund, returned 6%, with the American oil companies close behind. At the bottom of the table, we have the copper miners and hydrogen related fund. So on to the next section of the show, where we briefly discuss option ETFs. I discovered option ETFs in the 4th quarter of 2024, and I'm glad I did. My portfolio is held with Hargreaves Lansdown, and I've only been able to purchase the 2 ETF funds at the bottom of the table, XYLP and QYLP. Both are covered calls, and whilst the year-to-date gain may look small, it does not factor in that these funds are yielding 8 to 9% in dividends. And most importantly, the dividend is paid monthly. The risk with these ETFs is a sharp fall in the Nasdaq or the S&P 500 index, which can't be ruled out at the moment. hence the reason I've only allocated a very small amount of my portfolio. Now, before I get into bonds, it's probably worth pointing out that I hold about 25% of my portfolio in bonds. I'm not a bond fanatic, but I have learned the hard way that it always pays to have some certainty and stability in your portfolio. This is what bond ETFs give you: price stability and certainty of income. It's because of those features that it's difficult to talk in detail about bonds. So, looking at the table on screen, we can see that the emerging market bonds and corporate bonds are taking top spot. They're all accumulators, meaning they don't pay dividends. So, good if you've used all of your ISA allowance and need to hold funds or ETFs in a dealing account, as the return on the bond ETF is reflected in the price and therefore it uses your capital gains tax allowance and avoids income tax. We can see in the middle of the table and towards the bottom of the table that bond fund ETFs that distribute dividends have yields of between 5 and 6%. The difference between the top performing bond and the bottom performing bond is only 75 basis points. Flipping now to the bottom performing bond ETFs. My first observation is that they are predominantly all government bonds and they're all distributors of dividends. We can see that the lower half of the table typically yields less than 4%. UK bond prices have been depressed since the UK budget, and interest rate cuts in the UK and EU are now a racing certainty. It's likely that we'll see UK and EU bond prices rise from the levels shown on screen. The outlook for US bonds is less certain given the Federal Reserve chose to hold interest rates last week, and the inflation outlook under Trump remains uncertain. Those threatened tariffs could well push up inflation in the US. Turning now to the exciting part of the show, yes, equity ETFs. I always save the best for last. So on screen, we have the index ETFs for the major markets. Ahead by a long way at the end of January is the Euro Stoxx 50 with a return of 8.56%, comfortably ahead of the S&P 500 and the Nasdaq indexes at 3.25% and 1.95%. The tickers for these four ETFs are in the top right corner of the screen. Both S&P 500 and the Nasdaq dropped off at the end of last week in the wake of the Nvidia and DeepSeek story, but have recovered ground this week. The UK FTSE 100 has performed consistently throughout January with a 5% return. A quick comparison of the top performing equity market funds against Bitcoin, and we can see that the Euro Stoxx 50 is 2 percentage points ahead of the movement in Bitcoin for January. Now, since we're talking about Bitcoin technology, let's bring in AI. Let's quickly look at those ETFs which are heavily exposed to technology and blockchain. Positions 1 and 3 go to the cloud computing focused ETFs. The Wisdom Tree Cloud Computing Fund beating the Global X Fund by 2%. In second place is the Blockchain Fund by Invesco, which is leaps and bounds ahead of the Van Ecto Crypto Fund, ticker DAGB, in position 9. Let's look now at the top performing ETF funds across all asset classes. The top of the table is dominated by 3 gold funds with returns of 17%, as we saw earlier. In positions 4 and 5, we have country focus funds with Brazil and Poland both returning 13%. In position 7 and 11, we have sector funds focused on EU banks. We've already discussed the 3 commodity ETFs appearing in the table, so I'm going to skip over those. Progressing on now to the bottom performing ETFs. January's been a good month for equities in general. Consequently, not many funds have significant losses. Predominantly, the losses are in bonds and India equity funds. India had a great 2024, but the market is now looking expensive and domestic investors are taking a pause. Interestingly, in position 13, we have ticker IITU, a fund focused on US technology businesses. Into the section of the show now, which is my personal favourite, country ETFs. I do enjoy seeing which countries investors have decided to allocate their capital to. In top place, we have Brazil. I don't think that will last long if Trump imposes tariffs. We then have a steady stream of European countries led by Poland at 13%. My view is that Poland will continue to shine in 2025. The UK FTSE 100 is in 10th place and trails the rest of Europe. Scrolling to the bottom of the table, there are two Turkey-focused funds. The Amundi fund is clear ahead of the iShares fund by almost 1%, making it the preferred choice. Inflation is coming under control in Turkey, and that should benefit the economy if interest rates start to fall. There are a number of Chinese funds in the table, and all sit in the bottom half of the table. In this, the final section of the show, I want to spend some time contemplating dividend ETFs. The highest price rise in January goes to iShares USA Quality Dividend ETF, ticker QDIV, followed by IUKD, the UK dividend fund, also from iShares. Interestingly, in position 6, we have the Global X Super Dividend ETF, which is yielding 11%. I personally hold this in my portfolio. It pays a dividend monthly and is predominantly exposed to US and Chinese equities. And lastly, we have on screen those ETFs which are scheduled to go ex-dividend on the 15th of February. Now, if you've made it this far, thank you for watching. And please, if you could hit like and subscribe, as it really helps me to establish the channel.